Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about mortgage rates, the Fed, and of course, all the jobs data we're getting this week. Logan, welcome back to the podcast.
Happy Jobs Friday. You know, when this comes out, we're going to get a lot of answers. But once again, the line in the sand held. We had a weak ADP report. By the way, the ADP report has actually been weaker than the BLS reports for a few months now. So I don't know, by the time this ends, maybe Trump fires the ADP person, but jobless claims, headline claims picked up a little bit, continuing claims fell. The ISM manufacturing data, the labor component, the 10-year yield, try to test that 418 level a few times in the morning. By the last I checked, it was about 420. So we've held the line once again. But what does this all mean now? What does this mean going out not only for 2025, but going out to 2026?
I think that holding the line is a really good thing to talk about because a lot of people were like, with what's happening, they were really worried they were going to see, 8% rates or go to 5 on the 10-year yield. And it hasn't been like that at all. So maybe let's talk about that first. Why is that line held? Why do you have that line? How did you get that line and why is it holding?
I'm holding the cup, labor over inflation. We are sitting here today with year-to-date lows in mortgage rates because the labor market is getting softer. So the bond market over the years has gone lower when there's an economic growth scare or a labor scare. So in 2023, for those that don't remember or who are new here, the 10-year yield got to 3.37. I said, that's it. We shouldn't go anything below this unless we're in a recession because we're really pricing in a lot of weakness. We called it the Gandalf line. You shall not pass. That thing held 8 times. Tough. I mean, that's a very rare historical event, but it did. And then, the next line in the sand was the Hodor line at 380. So the 10-year yield comes down. It hits that level. I don't think we should break below unless we have a recession. We're really pricing in a lot of economic weakness based on Fed policy. See, the thing is that 65 to 75% of where the 10-year yield can really range is Fed policy. So the first Hodor line bounced up in late 2023. And then last year, we actually broke it for a few days. But then the economic data started to get better and yields shot up as they should have because Fed policy was still up here. And now this 418 level, the only time we ever broke this to go below this was Godzilla tariffs. And Godzilla tariffs was a bear market in stocks. Everybody talking about recession. We talked about it back then. If Godzilla tariffs stay as is, you could understand the concern. All hell was breaking loose there. But outside of that, even with the softer data, the 10-year yield gets here. It hasn't broken yet. So the only thing that breaks this is what's happened in the last few years. The labor data starts to get weaker and the bond market is basically trying to get ahead of the Federal Reserve. So this is why this Jobs Friday is key. But so far, it has not cracked, and it has not cracked with labor data getting softer for some time now.
Let's talk about that ADP data, right? So when you say, it's actually been worse than the other data, what did it show today? And were you surprised or not surprised that the line held?
The ADP jobs report is like, the orphan child of the labor data in Jobs Week, but if you look at the trend of that the last few months, it's noticeably weaker. So it's just following the BLS data in a sense that the jobs data is getting softer. And if you look at it in the last few months, and so I always say it's not shocking that this is happening because the two sectors we always focus on with economic cycles, residential, construction labor, and manufacturing, are both losing jobs. Hello, McFly. What's going on here? Time to get the cup out. Labor over inflation. Labor over inflation. So I think a good question is, why isn't the 10-year yield lower? Well, last year, everyone literally freaked out. They were really into the recession camp. And the jobs data was so much higher back then, too. But the jobs data is so much lower. So this is the conflict now because Fed policy is modestly restrictive for the labor market. But the Fed presidents and governors are telling them, hey, listen, 30,000 jobs, 50,000 jobs forever. It's okay. That'll be fine. But so it's a conflicting period right now. I always say this: you don't traditionally have a economic expansion without housing permits growing or home sales growing, kind of in that sense. And the builders, I mean, if the builders had to be paying down rates, it would be much worse. So policy is very restrictive in a sense for housing, that you're forced for companies to use their margin expansion to push down rates, because if that wasn't the case, new home sales would be even lower than now, and housing starts and construction will be lower. So we're just in this really, really unique situation where we have conflicting entities, right? Trump wants lower rates, but Trump says the economy's hot, and then the labor data doesn't agree with that. And now, the Fed says the labor data is fine. We don't really need to cut rates because inflation, and you got tariffs on one side, and you got the other side that says, hey, listen, 3% inflation targets, that's what we had, we're here. So now it's coming to fruition. Who blinks or what breaks first? So that's where we are at this point of the cycle between the Federal Reserve, Trump, the economy, the labor data, tariffs, everything. We're now in this time and we're right at that key technical line too. So it's just a beautiful symphony. Oh my Lord, it's just magnificent. Mozart would be so proud.
Uh, well, let's talk a little bit, because one of the things that's confusing me is that so you had that Fed people talking about, like, oh, the reason that we'd be okay if we only had 30,000 jobs or 50,000 jobs being created is because the labor force has shrunk. But is that because because they're cracking down on immigration and getting people out of the country? Like, what do you think about that whole, like, there are just less people to employ?
So this has been a big part of my work for a very long time. The baby boomers are retiring and they're dying off. Nature wins, right? What do we always say for years now? Sarah, we've
Yep.
been doing this for 5 years now.
We've been doing this a long time.
Yes, no country has a Dorian Gray labor market. If you don't know who Dorian Gray is, shame on you. So, eventually, especially places that do not have a lot of young people, living there, it's harder and harder, right? Yeah, you were Kansas City, right?
I was in Wichita.
Wichita, yeah, a lot of older people there in Wichita.
Lots of older people.
Lots of older, not a lot of young. So when that labor force leaves or can't work anymore, it's harder to get, people coming in. So how do you combat that? You either have productivity gains, robots, or immigration or migration, right? Either one. Migration to states can help the labor force. But in this case, population growth is really slowing down. But I do not believe it's particularly just that, because we wouldn't have residential rates are too high. Very simple, right? Mortgage rates are too high to have residential construction workers growing, because housing starts and permits aren't growing, and this has been happening for years. So that's not an immigration thing, right? That's a rate thing. New home sales have been basically stuck in a range for some time. So the builders are piling up on supply. That has nothing to do with immigration or demographics, really, in a sense. Manufacturing has been slowly moving lower for some time now. And the places that need borrowing costs, those things that matter to them, are being impacted. So that's more of a policy side than just the demographics and immigration and population growth issue.
So from your perspective, obviously when I first met you, your whole thing was talking about 2020 to 2024, and had been for a while. You were looking forward to this period of, it was going to be sort of a sweet spot of the demographics people coming into their home buying age, and that millennial demographic, this huge cohort of people coming into the home buying age. So now here we are in 2025, and not only do we not have that, that millennial wave is now, they should have reached that age already. Now we have a whole bunch of immigration. So how do you think immigration, plays into this?
They're still there. People are still
Okay.
there. It's a total principal interest tax insurance. A hypothetical. Let's just say home prices never rose anything, stayed flat the entire time. Mortgage rates stayed at 4.5% for 2020. Home sales would be much higher. New home sales would be much higher. Housing starts would be growing. So what happened is, the reason I always say that the housing market was unhealthy in 2020, very unhealthy in 2021, and savagely unhealthy, is that, prices escalated out of control. This was the whole team higher rates thing. So that's nothing to do with immigration or demographic. We have over 340 million people here in America. We have over 162 million people working, right? I guarantee you this. I always ask people this, and this is where I test people, because I ask them right on the spot. If mortgage rates fell 1 to 1.5% and stood there, do you believe home sales would rise or fall? Raise a hand. And you have people who hesitate answering because, they say Americans are poor, they're not very educated, they can't afford housing, whatever it is. But if they raise their hand, they'll admit this is a rate story, right? And then there's a group that says we have to keep higher rates, we have to crash home prices because nobody could afford a house. And those are the degrowthers, right? So that doesn't work because the Fed doesn't make policy around that. It's nominal growth, inflation expectations. So here, if rates fell, demand picks up. Right. And then the group says, well, rates can't fall because then demand picks up and prices increase pretty much every year post World War II outside of, 2007 and 11 and in the early 1990s. So we have the people. It's an affordability issue first, and affordability can't be just helped by rates. It has to be helped by wages and prices cooling down. So they're there. They did not just, fly in an alien ship and move away. We've got the people, but housing is total, that's why we had this model for 2020 to 2024. As long as home prices didn't grow over 23% for 5 years, we wrote about that, we talked about that,
Yep.
Then we'll be okay. And it's funny because back then people go, oh my God, home prices are so high, they're above the 2006 level, home prices have to crash, and it just crushed. It's like a tractor running over these people's faces, just absolutely no clue what they were talking about. But in any case, that's the housing situation. That's not demographics. That's not, those people are still living and working, but the cost of housing is so much. Prices, taxes, insurance, rates, everything. And over time, it does get better, but it needs multiple variables. So I don't think the housing issue is so much a demographic issue. We have 5 generations of buying, millennials, Gen Z, Gen X, baby boomers, silent generation out there. So we got the benefit of the U.S. versus other countries is other countries like China, Japan, and Europe, their prime age population growth peaked already. They're in a decline. We don't. We still have a lot of young replacement workers. So you do the buyer profile. So I don't believe housing is a immigration or demographic issue, nor we're sitting here with inventory near 2019. Obviously, BlackRock and Blackstone and Wall Street aren't buying all the homes. Shocking enough out there. But this is a housing inflation story that impacted demand.
Thank you for weighing in on that. Always want to hear what you have to say. You've been watching this so closely from a lot of different angles that I think are different than some other people. So love to bring that up every now and then. Let's turn to the Fed. Okay. Let's turn to the Fed because this is a crazy week. We know that, one of the reasons we're watching the job numbers so closely is because that's going to be the last jobs week before the Fed meeting. And we also have a very active administration going after the Fed, which we've been chronicling. And today we saw that the Department of Justice has opened an investigation into Lisa Cook, who is one of the Fed board members. And so the reason this is important is because Trump wants her out so he can put another person in that will vote for his way, correct?
Yes, bully ball. This is exactly. And here's the when we talked on like November 7th, 2024, we said, a few things. The White House needs a lower dollar. They need lower energy prices. And if they can get lower mortgage rates, nobody's going to care about Lisa Cook, Jerome Powell, none of the Fed members. If mortgage rates go lower and people buy homes, nobody cares about the Fed. Trump knows this. This is where Trump is a little bit more clever than people think. If rates went lower and home people he's just going to brag about it and everything, and there's nobody's going to care. So he can't quite get there yet because, inflation is still running higher than 2% and he doesn't have enough people. So what do? What we've talked about a few months ago, he will go after Fed governors. And you said, what skeletons are you talking about? Everyone's got skeletons, it depends on how big they are. And they found one and they're going after Cook. And who knows how that turns out or if there's enough time. But in any case, Stephen Meyer right now is being vetted in Congress right now. Trump said it. I'm going to get the votes. He's going to get the votes. He's going to get a Fed chairman that agrees with him. They're going to lower rates. And in this case, even if the 10-year yield doesn't cooperate as much, the ARM loans will start to be pricing in the mid fives, low fives, and they'll be highlighting that. And what we've seen is the sub 6% mortgage market housing data looks noticeably better. I mean, the builders are still at 2019 sale levels. That is like 1 million more home sales today. So Trump knows this, like how to like take this message and go with it, but he only has 2 of the 3. He doesn't have the third one yet. And then whatever happens with tariffs, because tariffs are a tax, right? You tax the consumer or you tax the corporations, profit margins get hit. It's not like the dollar accelerated higher to make the impact less. And whatever happens in the future, the Fed and Trump are in a collision course, and we're at this very key technical level. But if the labor data breaks, doesn't matter what the Fed wants, doesn't matter what Trump wants. The 10-year yield typically goes lower in that because then now you're starting to lose jobs. We're not there because jobless claims in there, but we have to be mindful of this. And I don't know how they're going to resolve this situation, but we clearly have one side that wants the numbers to overthrow Powell. And then we have one side, it's not just Powell, there's other Fed presidents who are even saying they don't want any rate cuts at all. So this is a conflict, and we're at that key level. It's just beautiful. The 10-year yield, it can't break under 418. It's Jobs Friday. We've had a few months of softer labor data. Manufacturing jobs are being lost. Residential construction jobs are being lost. The challenger job cuts are the highest level since 2020. The job openings, we have all these variables. They're all moving into the big fight. Godzilla versus King Kong, right? Middle of Tokyo. And this is where following data really starts to matter. And the labor data still runs them all, and jobless claims still runs them all. And the Fed is still holding on to that last line of defense. So they can stay as restrictive as possible. We go back to 2022. That's what I said. The Federal Reserve will stay as restrictive as they possibly can until the labor market breaks. And when the labor market breaks, the long end of the bond market does most of their heavy lifting. And then the Fed plays catch up. So we're just at a very beautiful inflection point right now. And I would say it's really hard for the 10-year yield. You need a 10-year yield to close below 418 and get follow through bond buying for this to even work. But yeah, here we are. It's just a lot has gone on in 2025. You think about all these crazy stories that were out there. We need a recession so we could refinance the debt, or we have to fire the BLS because there's these things that are just not part of a normal cycle, and our job is to try to make sense of it. But we always keep the story very simple.
I think it's
always about this.
He's showing the labor over inflation cup. Yes. For those people who are just listening, they don't know what you're doing.
I know they're not. That's why you're supposed to say, yes, Logan's Logan a cup that says labor over inflation.
I'm supposed to give the show notes here. Yeah, I think your point about the Federal Reserve, I think, is really well taken. So everybody in our industry, the people who listen to this podcast, super smart, in the top 1% of the people in this industry listening, getting their information, data-based, all that. Your general person out there, your general consumer, they have no idea what the Federal Reserve does. They might have heard the name. They're like, I don't know what that is. Something about rates. And to your point, like, they're not following this closely. They don't, maybe now with Lisa Cook so much in the headlines, maybe they're like, what's going on? But, I think I agree with you that if rates fall for whatever reason, it's a win for Trump. And he, whether that's the bond market getting ahead, whether it's the Federal Reserve, he's going to take it as a victory. And our industry would take it as a victory.
It's the Trinity game plan, right? Lower dollar, lower energy, lower rates. And then whatever happens with tariffs, they think they can offset that. Why? Because people look at gas prices and then people look at mortgage rates. And that's just a general what they see. They can buy more homes or they pay less for gas.
My
So
only
that's
thing
just
on my only thing on that, and I've told you, is that I feel like food prices is where it hits people the most, especially if you have a family and you are buying. I do not know how you're doing it right now. I mean, I'm buying for one person, but at some points in my life, I've been buying for 10 people, 10, 8 kids, 2 people, for a long time, my 4 kids and I, so it was 6 people. So like, I don't know how you're affording that right now. If you're, just a general average worker who doesn't make a ton of money.
certainly you're not door dashing like I do.
No, you're you're probably in the top 1% of Door Dashers. They probably have your picture on the wall of DoorDash somewhere, and they're like, "This is our
You
guy."
know what's the funny part is I remodeled my kitchen and I put a picture of it on Twitter, and one of my totally nerdy friends is like, "Tell me that you never cook or you're always ordering DoorDash," because I clearly do not have anything in the kitchen that would resemble anything that I cook. But to your point, of course, if you look at the history of inflation in politics, no politician has ever survived an inflation push. That's just the way it is. This is why it was very adamant for Trump, even if he did a back deal with OPEC, to get energy prices down and needs rates down. Because imagine this: imagine if mortgage rates were at 8% and gas prices were much higher, $1 higher. The tariff situation wouldn't work because
Right.
everybody would be complaining about high energy prices, high mortgage rates, and now you have goods stuff being come in at higher, the $300 billion revenue. Nobody's going to care about that. So the only way this works is energy prices go down and mortgage rates go down. Those are the things that but it's tricky. I wrote about this in December of 2016 about what possibly can you do for manufacturing and the whole trade war to trade deficit. And the U.S. is a very unique country in a sense. We're the domestic consumption economy of the world, right? We consume goods and services, and trade deficits are very normal in that because we just consume a lot more stuff. Other countries are just too poor to have like balanced trade deficits, But uh, again, here it is. We get to test. This is not just a 2025 story. This goes into 2026, and Trump now has to get the Supreme Court to allow him to even have those tariffs to even go up. So there's a lot of chaos out here. And one of the things that I say, like a counter to maybe some of the bearish takes, is that in 2018 and 19, business investment went to zero because nobody knew what was going on with the trade war tap dance. So now, if they could somehow resolve the Godzilla tariffs and get some clarity, the economic data has a potential to do better in that, just like it did. Right before COVID, all the economic data was getting better. A lot of people were in the recession camp, but the early data were starting to recover, and a lot of people just let it go. They didn't care about it. They just went full recession mode. And by the time COVID came here, the data was really good. I remember because I wrote an article about every pre-COVID data line, and it was all positive. ISM, retail sales, housing, everything was on an uptrend. And then COVID hit us. But Sarah, it's just going to be a lot of fun. Jobs Friday. We'll see what it is. But to me, the 10-year yield doesn't really want to break under 418. And it really does need a weaker jobs data to do that, to take it to that next stage.
We will see what happens by the time this comes out. Shortly after this comes out, we will get that data. We're going to be all over that. You're going to be writing articles. We're going to be doing another podcast. So stay tuned, guys. But Logan, thanks for joining today. As always, great to have you.
Pleasure.